$61 billion has entered the ETF market since the beginning of the year. So let's talk about what flows could look like for the remainder of this year. We want to bring in Tom Lydon. He's VettaFi's vice chair for this week's ETF report, brought to you by Invesco QQQ. Tom, it's great to see you here. So certainly $61 billion has flowed into the ETF market since January 1st. What does that signal to you just in terms of the demand that you're expected to see going forward?
Well, we had the second biggest year in flows last year, over $600 billion, and it's off to a good start, Shauna, but it's telling us something completely different. On the equity side, most of it was U.S. flows last year. This year, so far, 5 times as much money has gone into international ETFs, developed markets and emerging markets, and all for the right reasons. Valuations are a lot less expensive, almost 20 to 30% less on a PE side. And when you look at emerging markets, in some areas, single-digit PEs where we're seeing 17 PE here in the U.S. So people are looking at opportunities. They're also looking at the pendulum kind of swinging back towards a little bit of love for some of those unloved areas.
What are some of those areas, and what are some specific funds that would allow you to take advantage of that?
Well, a couple of the ETFs that have gotten the most flows so far this year is the JP Morgan Beta Builders Europe ETF, ticker symbol BBEU, and then the iShares Core MSCI Emerging Market ETF, one of the best emerging market ETFs out there at a very inexpensive price, IEMG. Those are some that are getting collectively almost $8 billion so far this year, David.
Tom, what are you hearing from advisors just in terms of the mixed data that we are getting? Lots of talk about a looming recession, yet time in and time out, it seems like we keep getting these econ data numbers that are very, very impressive. How is that influencing the thinking right now on the street?
So great question. We're surveying advisors all the time at VettaFi. They are feeling like the Fed's got this inflation thing under control, which is good, although they've baked in a couple more rate hikes. At the same time, they know they can't top tick rate hikes. So what they're doing is pushing longer duration, lower credit quality, trying to grab more longer term exposure as far as yield. And they know that this is not going to happen forever. So they're grabbing it while they can. A couple of the ETFs they like on the fixed income side are the iShares Investment Grade Corporate LQD, and also the iShares 20-plus year Treasury ETF, TLT. Again, longer duration, lower credit quality as far as the corporates, and high yields are also seeing some opportunities too.
Tom, we're always trying to play the trends, and we would go back, 6 months or so, there was talk about a hard landing, a tough recession, and then it kind of shifted to a soft landing. We'd be okay, but maybe a mild one. Suddenly, the new talk is shifted to no landing, no recession, just keep on sailing. How do you invest in that strategy?
Well, number one, you want to make sure you're invested. A lot of people have taken money off the table the last year or two. Having cash has actually felt pretty good, and now you can actually get paid for it. So that's been great. I think what a lot of advisors are saying is don't operate on your stomach, make sure you're allocated, and it may be that the S&P is not the place to be. You look at compared to 4 months ago off of the low, the S&P is actually the worst performing area of the market compared to the NASDAQ 100 that was up 17% since then. The S&P equal weight, it was up 19% compared to the S&P being up 15%. And then small cap has almost trumped them all, not only since the low, but also so far this year. A lot of people have not loved that area of the market. But if you look for international opportunities, one opportunity is the iShares Europe ETF IEV, up 30% in the last 4 months. There's a lot of good opportunity there to take advantage of. The big thing is be diversified. We've had a home country bias, and we've had way more invested in the S&P 500 than should be from a diversification standpoint.
Important points there. Tom Lydon, great to have you. Thanks so much.